Hello and welcome to the week ahead with me, Fiona Singh-Cotter, Senior Market Analyst at City Index. So we'll be looking ahead to the coming week, but which starts the 1st of September. So not only a new week, but also a new month. Before we do that, I'm just going to ask you to read through the risk warning, and I will put myself on mute while Okay, so let's get going. So let's just start with a very quick recap of what we've been watching this week. The US stocks rose across the week. US dollar also inched higher across the week. We saw US stocks, the S&P 500 and the Dow Jones hit record highs before just easing lower on Friday following core PCE data, which showed that US inflation rose to 2.9% year on year in July. That was up from 2.8% and marking the highest level in 5 months for the Fed's preferred gauge for inflation. Now, it hasn't really changed Fed rate cut expectations within the market. The market's still pricing in a 25 basis point rate cut in September, priced in at around 85%. This week we have seen the focus has been very much on the Federal Reserve. It's been very much in the summer doldrums. So we have been a little bit, quieter than potentially normal. The focus has been very much on what's happened today on Friday, but we've also had the drama play out between between President Trump as he fired Lisa Cook, the federal governor, who then has retaliated with a lawsuit. So very much been questions over the independence of the Fed. Now, I wonder whether just as we head into the new week, Monday is in fact Labor Day in the US. So the markets are on holiday in the US. Obviously, the US dollar will be trading as usual. But I do think across the week, we will also be seeing potentially more developments as far as this sort of Fed independence and Trump are concerned. So the main data point for next week will be the US non-farm payrolls. So, I mean, there are plenty of little data points across the week. We've got US ISM manufacturing. Let's just have a look at what's going on. ISM manufacturing. We've also got the ISM services, ADP payroll report, and then obviously the non-farm payroll report on Friday. So there's a good chance that the market will be in a wait and see mood across the week unless we see sort of, any big misses or beats on the US data front. We'd expect, we could see the markets in a wait and see mood, especially because they're hovering around that all-time high, just, grinding higher really, very slowly, very cautiously. As we head into September, September is typically a negative month as far as US stocks are concerned, one of the poorest months across the year for US stocks. And obviously we do have the Federal Reserve interest rate decision in September as well. So obviously this data will be very key for the markets as they try to gauge the likelihood, probably not of the rate cut in September, which feels like it's almost a given right now, unless we have particularly strong jobs data and CPI data, which still has to come out before the rate decision. But yeah, so let's just kick off then with what we'll be watching. As I mentioned, we've got on Tuesday, first up will be the Euro-US dollar will be in focus given the Eurozone inflation figures. So this is Euro-US dollar chart we're looking at. What to expect? Eurozone inflation is basically expected to remain unchanged at 2% in June. This data comes after figures on Friday today showed that German inflation tipped higher to 2.1%, whilst inflation in Spain and France was cooler than forecast. Now, from a policy perspective, markets are pricing in around a 34% chance of a 25 basis point rate cut by the end of the year. as there has been a further fading of rate cut expectations after the US-EU trade deal agreement, and amid signs of a more resilient than expected Eurozone economy. That said, euro strength, should the euro start to strengthen to levels that could pose a risk to inflation, then we could see the voices on the governing council growing more in favour of further easing, but that is not the case just yet. Now, this is euro US dollar. We've seen that this medium term uptrend remains intact. The price reached the 2025 high of 118.30. We have seen a series of lower highs since then. We did see a recovery off this level here of the 114, the August low. However, the recovery has failed to move above that 117 level and continues to create lower highs. So buyers do really need to see a close above that 117 level. That's what we've been watching at. If we do get a close above that, especially a weekly close above that, that would be opening the door to 118 and potentially 118.35. That's the 50 SMI that we're just finding some support above at the moment. On the downside, a break below that 50 SMI there at around the 116.70 level opens the door to 115.75. That's the weekly low, and a break below there would actually create a lower low, bringing in the 100 SMA and also the rising trend line support on the downside. So if we get weaker than expected inflation, for example, against a strengthening US dollar, then that could see the breakdown below that level there. But broadly speaking, just seeing momentum start to pick up, so there is more risk of a break to the upside as we head into the weekend. So what else are we going to be watching? That's euro US dollar. Then we've got the ISM manufacturing PMI. Just going to bring up, for example, the US dollar, Japanese yen, and how that's performing with regards to the US dollar strength across this week. Haven't really seen much of an impact on the US dollar, Japanese yen. But if we look towards the US manufacturing PMI, that may give us some clues as to the health of the sector after President Trump's, or amid President Trump's desire to bring manufacturing back to the US. So US ISM manufacturing figures could provide a clue as to whether manufacturing is in fact increasing in line with Trump's trade policies and what he's trying to achieve. Now, as far as a base for comparison is concerned, the S&P global manufacturing PMI rose to 53.3 in August, up from July's 49.8. That actually marked a 39-month high and highlighting sort of improving factory conditions. We saw output climb for a third straight month at the fastest pace since May 2022, boosted by the largest inflow in new orders since February. So it would appear immediate sort of analysis of ISM manufacturing data is that Trump's trade policies do appear to be helping the manufacturing sector. So the market's going to be looking closely to see whether this trend continues in the ISM manufacturing PMIs, with attention also on cost pressures. Now, if we do get stronger than expected data, we could see a strengthening of the US dollar against the Japanese yen. This is the pair at the moment. It's trading pretty much in a very familiar range where it's been since the beginning of the month, protected by that 50 SMA that is just testing at the moment around the 147 level. A break below that is going to bring the 146 level into focus, and also then below there we'll look at the 145 psychological level. That's if we're seeing weaker than expected US data, which could weigh on the US dollar. However, if we get stronger than expected manufacturing, we could find that that 50 SMA there is actually holding, which may prompt a rebound back towards the 147 level, which is also just around the 200 SMA at 149. So if we get a move above that, that's going to create a higher high. It's also going to move above the 200 SMA, which will be encouraging as far as the chart pattern is concerned, opening the door to 150. There isn't so much data for Japan due to be released this week. So yeah, that's the US dollar, Japanese yen. Just as far as what else we'll be watching, Australia GDP. Okay, so let's have a look at the Aussie US dollar. Again, we've seen this sort of period of lower highs that's been in, it's only near term, but as far as Australia GDP is concerned, let's have a look. Expectations are for, bear with me, a subdued expansion of around 0.4%. This comes following growth of 0.2% in Q1, putting annual growth expected to be at 1.3% annualized, which is below the RBA's forecasts of 2% growth. Basically, the recovery in the economy is showing signs of stalling across the first half of the year, with consumption proving to be weaker than expected. Consumer spending improved modestly in real on real income gains. However, momentum has slowed. Now, commodity exports also rebounded, led by iron ore, so imports are likely to be around flat net. I think if we get weaker than expected GDP for Q2, that could actually reinforce the fragility of the growth backdrop in Australia and support market expectations of further RBA rate cuts into the end of the year, which could weigh on the Aussie dollar. Market's currently pricing in a 20% chance of 25 basis point cut in September, so weaker than expected data could indeed increase those rate cut expectations. Now, just as far as levels to be watching are concerned, as I said, we've been rising across the year, hitting that peak in July at 0.66. However, we've been forming a series of lower highs since then. Just as far as levels to be watching on the downside, we've recovered from that low around the 64.23, and we have pushed above that falling trend line. So next level to be watching on the upside is going to be this level here, which was the 65.70. That was the high that we saw back in mid-August. Now, if we can get a move above there, that brings the 69 level, 66 level back into focus on the upside. We have moved above the 50 SMA and the 100 SMA, still above the 200 SMA. So we are seeing buyers sort of hopeful of further gains, supported by momentum, with the RSI also on the rise. So as I said, if we can get a rise above that sort of 65.50 level, that's going to bring the 66 back into focus. As far as support is concerned, immediate support there at 65.20, that's the 50 SMA. Below that, you've also got this level here, which is the 100 SMA, 64.80, and below that, then we've got these levels here, which we found the support back in August, early August, down at 64.25. So what else we'll be watching? There's Chinese PMI data also to be watching out for, services as well as the PMI figures. for manufacturing, expected to show that manufacturing remained in contraction, although services is expected to see some growth. A speech by ECB President Christine Lagarde, obviously that's probably going to play second fiddle along with the Eurozone retail sales to the Eurozone inflation data that we've already spoken about. And then just finishing towards Friday, or towards the end of the week, we've got ISM services PMI data. Now this is really interesting because obviously the services sector is the dominant sector as far as the US is concerned. It accounts for around 75% of job creation, job employment, and also 75% of economic activity. So as a point of comparison, the S&P Global Services PMI actually fell slightly to 55.4 in August, down from 55.7 in July, marking a 2-month low, but still pointing to robust expansion here. Average prices also climbed at the sharpest pace since August 2022, reflecting the ongoing cost pressures being passed through to the consumer, through the services sector. So that's something that markets will be watching closely to get more ideas over cost pressures and inflationary pressures, which appear to remain elevated, but that doesn't seem to be affecting so far the trajectory for services, which remains solid. Now this is the Nasdaq that we're watching here. Didn't quite make it to record highs that we saw with the S&P and the Dow Jones, and that's basically because we're seeing a bit of a move away from tech stocks into other areas of the market. And after we saw those Nvidia results this week, which beat expectations, but with a stock that's priced for perfection, whilst it beat forecasts, analysts' forecasts, it didn't impress the investors, so it actually fell slightly following the release. But as far as data is concerned, now, I mean, this is the thing to bear in mind. If we get weaker than expected data, actually, we could see Fed rate cut expectations rise, which could actually prove to be beneficial for the Nasdaq. But obviously, if we get data that's too weak, then obviously that will then prompt concerns over the health of the US economy, which could actually pull stocks lower if investors are spooked in any way. Just as far as levels to be watching here, this is the 23,500. We've just broken below that after really finding some resistance at the midpoint of this rising channel. But again, you know, nothing serious. This is what we'll be watching out for here is around the 22,250. That's the 50 SMA and also the lower band of the rising channel as a support level. But it'll take a move below the 23,000 to actually create a lower low and then bring the 22,800, 750 level back into focus, which is the August low. But, you know, as I said, we're trading in a rising channel, so we're just sort of in the lower bounds of that rising channel, but it's still a rising channel. So on the upside, levels to be watching would be the fresh all-time high around above that sort of 24,000 level, just below there. 23,670 is where the record high sits. So, you know, if we get encouraging data, then that could also help push the stocks higher as it sort of calms concerns over negative impacts. But cost pressures, that would be something I'd be watching quite closely. If we're finding that the cost pressures are rising quite dramatically still, then the market could get spooked by those figures. Okay, and then UK, we have UK retail sales. So this week's been relatively quiet as far as UK data is concerned. We've not really had much at all. We did hear from Bank of England policymaker Catherine Mann, who suggested that the Bank of England should be keeping interest rates unchanged for a prolonged period She is a known hawk on the panel. But so the pound has been broadly supported by expectations that the Bank of England is not going to be cutting rates until next year. However, there was a little bit of a sell-off today, some weakness amid these news that, or stories that Rachel Reeves may be looking to place a windfall tax on banks regarding the reserves that they, or the interest that they earn on reserves at the Bank of England. Obviously that's not something that's gone down well as far as the markets are concerned. Banks have fallen quite sharply, but it also just brings fiscal worries back into the forefront for the pound ahead of the autumn budget in October. Rachel Reeves is keen to get some revenue from somewhere, and it appears that big banks may be the next on the hit list. But we can see here pound is trading caught between the 50 and the 100 SMA, found some support today at 134.35. That was the 100 SMA. It's also a level which has offered support previously, but the actual key support there is around the 133.85 level, which is a level that's offered support again on several occasions across the past few months. If we did see a break below this support zone, then that would create a lower low, opening the door to potentially a lower low towards the 132.50 level. If we find these levels hold, then we could be looking for a move back up towards 136. That's a level on the upside. If you get a rise above there, you're creating a higher high, changing the dynamic of the chart from this relatively neutral stance that it has at the moment. And then just finally, we do have the US non-farm payroll. Now, the main focus, let's have a look. So this is the Dow trading around its record highs. So as far as US non-farm payrolls are concerned, they will be expectations of 75,000 jobs to have been added to the US economy in August. That's modestly higher than the 73,000 added in July, but still weak as far as historic levels are concerned. Unemployment rate is expected to rise to 4.3%, up from 4.2% previously, with the Federal Reserve projecting 4.5% rate of unemployment by the end of the year. Now, average earnings are also seen rising 0.3% month on month, matching July's figures. Investors will be using the ISM manufacturing and services job components together with ADP payrolls and JOLTS job openings to gauge the likelihood of a stronger payroll gain than forecast. But in terms of implications for the Fed, the market is pricing in around an 87% probability of 25 basis point cut in September meeting, hotter than expected core PCE figures rising to 2.9%, as I said, hasn't changed this rate cut outlook, but a significantly weaker than forecast payroll report could increase rate cut expectations, which could actually be beneficial for stock market. But as I said, that may only be the case as long as it's just a bit weaker. If we have drastically weaker than expected data, that may actually unnerve the markets with regards to the outlook for the economy. Now, this is the Dow Jones that we're watching. As I said, rose to a fresh record high this week of 45,730, above the previous record high of 45,760. That doesn't sound right. Sorry. So 45,730, that's right. So we're still trading above that rising trend line. What to watch here, that we do have a bit of RSI divergence going on. So we've got fresh highs over there, and then we're actually seeing the RSI falling, which tends to be a sign of a potential slowing of momentum and a move lower. As far as support is concerned, 45,000 level to be watching on the downside, and then below there we've got 44,450 which was also the 50 SMA to be watching on the downside. So if we get a significantly weaker than expected report or a significantly stronger than expected report, which reins in Fed rate cuts expectations, then we could see some downward pressure. If we get that sort of Goldilocks report that supports the case of further rate cuts from the Fed without causing any alarm, then we could see a potential to move to fresh higher highs next week. So those are the main things that we're watching. I hope that you have enjoyed this, and if you have, then we look forward to seeing you again next week.